Welcome to the Flow Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 3:04 p.m. That is Central Time. And today is January 5th, and today being Friday, it's the big picture, long-term audio and video for the various different asset classes. I think when subscribers hear that and then being presented with an intraday chart, they might be thinking, well, golly, what's he talking about? We certainly had a lot of volatility today in the bond markets. Let's set aside for the moment why it happened and think more broadly about what it means for the entire market. That you see one piece of data come out and bonds surge. You see another piece of data come out an hour and a half later and bonds collapse. And then you finish out the day as a wash and is pretty much unchanged. So there's fuel for lots of different arguments. And if one were simply looking at intraday charts, then you wouldn't have an awful lot to go by here, except for the fact that you have a doji, that it's a kind of a day where nothing happened, but a lot happened. And it's all down to what's happening on the economic front. But of course, the problem with looking at these economic statistics is that they tend to be revised. And then you don't know about the sample size, or how many people are being asked, how many businesses are being asked, how important are those businesses. And it does really help to highlight that the vagaries of relying on economic statistics to make individual investment decisions is fairly flawed. So what we should really be thinking about is that they will move the market on occasion, and that occasionally they will be given greater weighting than might otherwise be the case. But let's then think about what it means to look at it over a lengthier period of time. So let's look at 10 years of data. And then, of course, what it means is that all those individual economic statistics get smoothed out. Personally, I think that the biggest thing that's happened over the last year was the massive downward dynamic a year ago. The yield got all the way up to 5%, failed, huge downside key reversal, massive follow through on the subsequent week, immediately unwinding the overextension relative to the 200-day moving average. And then that obviously was a massive reaction against the prevailing uptrend, which had been this incredible acceleration higher from close to 0 to 5% in the space of only about a year. And then subsequently, we've had this lengthy period of right-hand extension, where it managed to briefly sustain a move above 5% and then has subsequently come straight back down again.